Most people massively underestimate how quickly their portfolio can snowball once you already have a bit of a head start. So today I want to show you how quickly a 100k portfolio can compound when you contribute regularly. I think the timeline might surprise you. This is just simple maths, not financial advice. We're going to start with our 100k. I'm using an annual growth rate of 12%, which I'll explain a little bit more why I'm using that in just a moment. And we're going to assume that we can afford to put in £500 per month. The reason 100k is such an important milestone is not simply because it's a round number. It's usually where the capital growth from investments starts to be the main driver rather than your regular contributions. Let me show you what that looks like. This is showing a yearly breakdown, and you can see it from the deposits. So we're investing £6,000 per year, £500 per month. After year one, with that 12% growth rate, we're expected to have 18,000 more in our portfolio, 6 coming from our deposits and just over 12 coming from capital growth. So you can see just after year one, we're getting double the amount of our contributions just in capital growth. And you can see how that compounds from there. After year 8, our portfolio is expected to grow by about £40,000 that year, which is roughly what the average UK salary is. After year 12, we'll have over £500,000 in our portfolio. And that's also the point that our portfolio has grown over 60k per year, which is 5k per month, £500 of that coming from your contributions. You can see how much of a difference that compounding has made. We're investing £6,000 per year, but we're getting nearly £60,000 in capital growth. Now let's have a look at what would happen if we were able to invest a little bit more. So say we were able to invest £1,000 per month. By investing this much, we were able to hit that 60k per year after about year 9, with 12k coming from our deposits and 49k coming from capital growth. Just 2 years later, we're getting over 64k just from capital growth. And after 15 years, our portfolio has hit over £1 million. Now there's probably 2 elephants in the room that we need to address. The first one being that 12% growth rate. And you'll probably look at that thinking that's a little bit extreme, that's not realistic. And I'll admit it is a little bit ambitious, but it is more or less in line with recent returns. If we look at the FTSE All World Index, its 5-year compounded annual growth rate is currently sitting at 12.5%. Its 3-year annual growth rate is sitting at 19.2%. Of course, that is slightly higher than its longer term averages. The most up-to-date data I could find shows over the last 20 years, the FTSE All World has averaged about 10% per year. This also compares against the S&P 500, which has averaged over the same period at 12.3%. So we have seen in recent years that these returns are slightly out of the ordinary, but it just shows you what is potentially possible. We're also not expecting this to be a straight line. We're not going to get the same percentage each year. This can be quite volatile. Some years we're going to get 20, even 30%. Some years it's going to be negative. This is looking at what the average return is going to be over that period. And the second thing to address is starting with a 100k portfolio. And you're probably thinking, well, of course it's easy if I can start from that level. But this highlights how important it is to get to that level as quickly as possible. If we wanted to do this within an ISA, realistically, the quickest we could do this is in about 4 years. If we were able to invest the full amount, so that's £20,000 per year, that works out to about £1,666 per month. Over 4 years, we'd have just over £100,000 at that 12% rate. But at this stage, the contributions are so much more important than the growth rate. Even if we used a 12% growth rate, the quickest we could really get to 100k is just over 3.5 years. So 3 years, 7 months, we'd have just over 100k. If we did 10%, then the quickest would be, I think it's 4 years, 2 months. We would have 101k. So you're about 6 or 7 months later, even though you've got half the interest rate, which is not that much longer. I think clearly it's not realistic to expect to be able to put the maximum in every year for a long period of time. But when the focus is on getting to that level as quickly as possible, the more you can put into contributions, whether that's making some small sacrifices, the more you can put in, the quicker you get there, then you can reduce it once you've built up that portfolio, because that's when compound interest and capital growth really takes over. If you really want to simplify your investing, I have a free ETF cheat sheet that you can download. It breaks down the most popular ETFs in different regions and different sectors, makes it easy to compare. It's the top link in the description below. The problem I see with a lot of portfolios is that people try to speed up this process. So they start becoming more active and they try and beat the market. But in reality, this actually slows them down. Use an index like the FTSE All World as a benchmark. This is looking at Vanguard's ETF that tracks it. And over 3 years, this has returned just over 54%. So a really easy task is to look at your portfolio over the last 3 years. And if it hasn't returned 54%, then you haven't beaten the market. And you've probably spent a considerable amount of time doing so. People look at these kind of returns and think this is not quick enough. But ironically, in trying to beat it, it ends up taking them longer. It's really boring advice when people just say, oh, you just need to invest for longer and it's just easy if you just don't touch it. But it's so true, and it really does highlight how important it is to have other aspects sorted as well. So things like having an emergency fund, so if something does come up, you're not likely to dip into your investments. Maybe have some short-term savings if you're saving for a holiday or a big purchase. Again, you're not going to dip into those investments. So everything that you invest into your portfolio, you've got at least a 5-year, hopefully 10 years plus of a time horizon. So one, you can ride out volatility. but also knowing that you don't need to touch that money and you can just let it compound. Put all your focus and emphasis on getting to that 100K mark by increasing your contributions as much as you can. And then once you get to that sort of level, then you can start to reduce your contributions if you need to put that money elsewhere. Obviously, the more you can put in, the better, but that's when the capital growth really takes over. And with that sort of time horizon, you don't need to worry about timing the market. The most important thing is time in the market and staying consistent. And especially if you're investing regularly, say every month, then even if the market does correct or it's quite choppy, you can get in at some of those lower prices. So if you're well on your way to growing your portfolio to 6 figures, then keep going because you're so close. If you're feeling like you're behind or you haven't started yet, it's never too late. It will always feel like the best time to invest was 5 years ago, 10 years ago. But I'll tell you this, the second best time is today. If you want to stop making mistakes with your portfolio, then watch this video next.